This video is a little bit different than my usual Analyzing Finance with Nick episodes, where I'm going to be giving you an excerpt of some of the research expert call that I did this month with legal expert Robert Scott. Robert Scott has a unique background because he was both a hedge fund portfolio manager at Millennium Partners and an attorney, first as a federal clerk for a federal judge and then worked at a Wall Street law firm. So his skill set is integrating the legal system and the financial markets to create actionable investing ideas. And in the clip that I'm going to share with you here, we're going to talk about changes in antitrust enforcement and what are the possible ramifications for deal making and investors in the future. We also just like to know is that it was hard for Bob to get connected with his video stream. So this one might be better for you just to listen to while you're working out than watching, because it won't be as action-packed. Let me know if you like these, and on with the main content.
What do you think about antitrust? It's been a hot issue for the last 3 to 4 years, with the Biden administration seeming to willing to take a much tougher hand, at least based on news reports. You're seeing a lot of tech stocks get hit, and a lot of deals that you think would go through by conventional merger metrics are pricing in a much higher probability of failure, because how big is too big for a tech company? Are they going to allow big tech companies to do any kind of mergers? We've seen this in deal spreads in companies such as the Microsoft Activision deal and the Adobe Figma deal, and how their stock reacted to it. So what are your thoughts on this?
So these are really good questions. Okay, so Nick, you're exactly right. The Biden administration has taken almost a 180-degree turn from the previous Trump administration on antitrust policy and enforcement. So let's start with Biden's executive order on promoting competition, which came out in 2021. That announced essentially a much more aggressive approach to antitrust enforcement, and that is driven by the Biden administration's fundamental concern that there is too much market concentration in the technology industry. So they are very focused on big cap tech, and as well as just sort of mergers generally. What Biden's executive order on antitrust announced was, quote, a whole of government approach to antitrust enforcement. So currently, antitrust is enforced through the Department of Justice and through the FTC, and they enforce different statutes. In the DOJ has authority to enforce antitrust actions under the Sherman Antitrust Act, which is to break up monopolies, and also under the Clayton Act, which is designed to target anti-competitive behavior in industries. The FTC Act, specifically Section 5, empowers the FTC to go after monopolistic behavior and anti-competitive behavior. Okay, so that's the statutory background. What Biden's whole of government approach is not just is he makes changes in what those agencies can do, but in addition, he put the word out to all federal agencies that they should now get very aggressive, challenging business activity within their respective jurisdictions or purviews. Okay, and in particular, focus on activity that the administration deems unfair, and then to initiate litigation if necessary or work in tandem with the FTC. That's essentially like a tax for a company if agencies start to enact a lot of regulations around that. So the previous standard under antitrust law is very favorable to the industry. The focus in antitrust is on consumer welfare. Okay, and so under antitrust law, simply being a monopolist or having a duopoly or an oligopoly is not grounds for antitrust enforcement. There has to be a negative impact on the consumer, specifically through pricing. That's why antitrust cases are very difficult to bring in the courts, and the federal government has a mixed track record at best in some of those cases. They are not easy to bring because the Supreme Court has set the law that the standard is the impact on consumer welfare and pricing, nothing else. So that favors big cap tech. What the Biden administration wants to do, they want to take a radical departure from that. They do not want simply consumer welfare. They want public welfare to be the issue, and they want to open up under that public welfare standard a whole new set of issues that can provide the basis for federal agencies to enforce regulation aimed under the antitrust laws, and that would be threats to competition, the effect of business combinations on the labor markets, supply chain impact, issues with respect to the climate, social equity and political power impact of mergers, and then, of course, digital. So the focus of the Biden administration is on dominant firms and gatekeepers and dominant middlemen and one-sided contracts. And the main trigger point for the Biden administration is market concentration. All right. Now, in addition to this whole of government approach, the FTC and the DOJ have gotten extremely aggressive, and they have abandoned the previous policies that those agencies had in place toward antitrust enforcement. So, Nick, you alluded to part of it. So let me just touch briefly on it. The government has withdrawn the vertical merger guidelines. The old policy, in effect at DOJ and at FTC, was that vertical mergers are not per se anti-competitive, and they're not scrutinized that closely. And that's in line with what the courts have done. They don't scrutinize vertical mergers particularly closely. Okay, but now the Biden administration has taken a totally different approach. They've abandoned the vertical merger guidelines, and then they're now urging the FTC and DOJ to scrutinize and confront all mergers, including vertical mergers. And the most recent example of that is NVIDIA and ARM, which is being challenged by the Biden administration. As well, they're challenging Illumina and Grail, but that's in the healthcare area. So the other thing that the Biden administration has done is they want to abandon the Herfindahl-Hirschman Index, which is the measure of market concentration that's used. They want to have a much more expansive approach to defining market concentration so that they can capture more companies and more mergers within that. And then, as I mentioned before, they want to focus on they want to replace consumer welfare focus with public welfare, which just creates an elasticity across all the agencies, including DOJ and FTC, to be very expansive in their view of challenging mergers. And I should mention that the last thing is they've abandoned the Hart-Scott-Rodino waiting period. If there was a merger and there was no public comment from the government, when that waiting period expired, that merger would go through. They've abandoned that. They said, you know what? We can still challenge your merger, notwithstanding that waiting period. Okay, so very briefly, I wanted to mention
that leads me to two follow-up questions.
Sure, go ahead,
With
Nick.
no HSR, what is the time frame for when a merger is going to be completed? Like, how are people who trade these spreads able to assess the duration risk of it getting broken up?
So that's a really, really good question. The answer is that's up in the air. Okay. That's up in the air. That creates a lot of uncertainty. And I'm going to talk about some specific mergers in a minute. But that question, Nick, is a really good one because it creates a lot of uncertainty. When they withdraw that, they're withdrawing a guardrail essentially to the merger process, and you're essentially beholden to the regulator.
Yeah, and then the second follow-up I have to that too is if you're changing the standard from consumer welfare, which is mainly just pricing power, to public welfare, how is that going to be measured? Is that just a unilateral do whatever I want, get out of jail free card for regulators?
So ultimately what's going to happen is that parties to mergers are going to challenge, if the government opposes a merger, and this year in 2022, DOJ has blocked 4 mergers, and they have forced 15 other mergers into consent agreements. But if the DOJ or the FTC are going to prohibit a merger, and they're going to cite, just call social welfare issues as being anti-competitive, then the parties are going to have to challenge it in court. And, you know, that's essentially not a good place for DOJ and FTC to be, because the legal system runs on precedent, and precedence favors consumer welfare standard. They would be essentially asking the federal courts to overturn the Supreme Court standard, and that the courts are not going to do that. Most recently, UNH challenged DOJ on the opposition to the Change Healthcare merger, and the court found in favor of UNH on that. So they're going to allow that merger to go forward. DOJ is going to challenge that. But here's the deal in antitrust law. It's a bad thing. You have very low odds on appeal for reversing a trial court in antitrust. And that's because antitrust is a very fact-specific area of the law, and the lower trial court is rendering a decision that is very fact-specific, and the standard of review on appeal is abuse of discretion on any review of facts. So the district court is virtually certain to be affirmed on its factual findings unless there was something totally off the wall and totally wrong. So what DOJ and FTC have to do, what the Biden administration knows that they have to do, is strong-arm companies in mergers and try and force them into agreements with the government that are more palatable to the government. But to your question, Nick, that's all going to have to get challenged in court.